Hey investor friends, I'm Michelle Markey, and today I'll be talking about two indicators that historically have done a decent job of predicting where stock markets will go in the coming months, and these would be death crosses and a potential inverted yield curve. And although yield curves of US Treasury bonds haven't inverted yet, that could potentially be on the horizon. So I'll talk about what these things mean and what we should be on the lookout for, as they could be big warning signals for stocks in 2022. And if you haven't already, it would mean so much to me if you could please like and subscribe to my video and YouTube channel, because I do a lot of research to help us be educated investors, and I greatly appreciate it. Thanks. So what is a death cross and why is it important? And we often see death crosses when a lot of stocks in an index are selling off. And a death cross simply is a technical pattern on a stock chart or index chart showing when a stock or index's short-term moving average crosses below its long-term moving average. And a moving average is just the average price of a stock or index over a certain period of time. So often to get a death cross, you would compare the 50-day moving average, which is the short term, and compare it with the long-term moving average of 200 days. So when the 50-day crosses below the 200-day moving average, that signals a death cross, and the opposite of this would be a golden cross, and then that would be a bullish sign for stocks. But right now, we've seen a death cross manifesting in the Russell 2000 on January 19, 2022, as well as the Nasdaq Composite on February 18, 2022. And these are extremely bearish signals, and both of these indices have been selling off massively from their highs in November 2021. And both of these have actually touched bear market territory, especially during the week of February 22, when it was the beginning of the Russia-Ukraine conflict. So that's when these indices really started going into the decline range of 20% or more. And this is why we're seeing these death crosses starting to happen. And death crosses are important because they've been a reliable predictor of severe bear markets, and we've seen plenty of them in the last century, where we saw them before the Great Depression and also the Great Recession. So it's possible that these could be happening again in 2022. And while death crosses just started happening to the major indices of the Dow Jones Industrial Average on March 8, 2022, and then the S&P 500 on March 15, 2022, the fact that it's happening in the small cap index or Russell 2000 could be a significant harbinger of things to come, as the Russell 2000 is considered a great leading indicator of the overall directionality of the stock market. And when there's declines in the small cap index first, that usually precedes declines in the other major indices, because smaller companies have difficult times absorbing economic shocks and still producing earnings, whereas large cap companies like the ones in the S&P 500 can better absorb economic shocks and still produce earnings. So usually we'll see declines first with small caps before it then starts happening with larger caps. And when the Russell 2000 breaks down to a new lower low, that's signaling that the whole market is getting ready for a bigger decline. And the last time we saw this is when a death cross preceded the huge declines we saw in the fourth quarter of 2018. And there was also a death cross that happened to the S&P 500. So that declined in a major way alongside the Russell 2000 back then. So it's quite possible if we saw a new lower low with the Russell 2000 on February 23, 2022, that could be potentially foreshadowing another lower low that could happen in some of the major indices. Who knows? Or maybe it will happen also with the Nasdaq. And part of why maybe the Nasdaq has been seeing death crosses is perhaps because people are rotating out of the more speculative growth stocks and trying to seek shelter in more value stocks, or maybe the S&P 500. So maybe this is why some of the major indices like the S&P 500 are holding up better than maybe the Nasdaq and Russell 2000. And then other reports suggest that a death cross doesn't necessarily mean that much, and it might not be very helpful for trying to do some market timing moves if you're interested in that. So it could really go either way. So even though it's definitely an interesting technical indicator, you shouldn't necessarily base your investing moves on this indicator alone. And what is an inverted yield curve, and why is it such a big deal, you might be asking? And at a high level, an inverted yield curve pertains to US Treasury bonds, where if the short-term interest rates are higher than the long-term interest rates, that's an inverted yield curve. And it's a big deal because it's been one of the best indicators for an upcoming recession in the US. And since World War II, a recession has happened every time there's been an inverted yield curve about 6 to 18 months after the inversion happens. So it's a pretty big deal. And the last time we saw this happen was in 2019 when yield curves inverted, and then we had the recession in 2020 as we all came to experience in the massive lockdowns and business shutdowns for a while. So that was definitely still correlated to the inverted yield curve happening the year before. And it could happen again in 2022 as Forbes warns, because when an economy is expanding, then the yields between the longer dated US Treasury bonds and the shorter term Treasury bonds tend to spread wider. So you'll see a steeper curve in the longer dated US Treasury bonds when we're expanding. But when the economy is contracting, you start seeing the spread decline. And we're seeing that now. If we look at a chart of the short term 2-year Treasury bond compared to the long term 10-year Treasury bond, and as the spread narrows between these two yield curves, that's an indicator that an inversion could be imminent. So when we see the 10-year yield curve go below the 2-year yield curve, then that's a huge warning sign, and then a recession could be happening at any moment thereafter. And naturally, when a recession occurs, that also tends to be correlated with declines in the stock market. So just something to keep in mind if this might happen in the near future, like toward the end of 2022 or even sometime in 2023. And people like tracking US Treasury yields because it's a barometer for US economic progress, and it reflects investor sentiment and their collective wisdom about expectations of future economic performance. And what I understand from a Financial Times article is that shorter term yields tend to reflect where investors believe short-term monetary policy will be in the near term. And then for longer term yields, that represents investors' best guess as to where interest rates, growth, and inflation will be in the medium to long term. And then as an economy is slowing down, then expectations for inflation also decline. So as that's happening, the yields on longer term dated bonds like the 10-year and 30-year bonds start also falling closer to the shorter term securities. And then that's where we get an inverted yield curve, because at that point investors believe that the Fed will have less of a need to raise borrowing costs in the future. So that's where the yield curves start to flatten and potentially invert. And also, some have criticized US yield curves for potentially being a self-fulfilling prophecy and bringing on a downturn as the yields start to flatten. So it's sort of interesting to study and sort of confusing, but I hope that what I said made sense. Another way to think about this is if investors believe that an economy is weakening and then they believe that the Fed will have to lower interest rates to stimulate the economy again, that usually affects shorter term interest rates. So then some of these investors might want to lock in a higher interest rate yield on longer term bonds of 10 to 30-year US Treasury bonds. And then that causes the yields to go down as prices of these bonds go up because more investors are piling into the longer dated bonds. So as the yields of the longer dated bonds go lower, that's when they start potentially going below shorter term yields as well. And that's where we also see that an inversion takes place. And then a recession could be a self-fulfilling prophecy as the inverted yields start undermining confidence in the economy. And even if stock markets get spooked by death crosses in the S&P 500 or Dow Jones, and if an inverted yield curve comes to fruition, a lot of the best investors are not fazed by some of these macroeconomic factors because they continue to study businesses and invest in them regardless of whatever's happening at the bigger macroeconomic level, because largely interest rates and inflation are out of investors' control. So the best that we can do is continue to try to find investments that are undervalued compared to what we're willing to pay for them. And then that's the best way that we should really go about it, and not dwell too much on some of these things like inflation and death crosses or inverted yield curves, because all in all, they don't necessarily impact if there's a good stock buying opportunity or not. Sometimes there are stocks that are still on sale regardless of whether the overall economy is in a recession or not. So that's just something something to keep in mind and what I hope to be doing. But to me, looking at some of these technical indicators can be fun sometimes, because if I know that a recession might be on the horizon, then perhaps that might lead to some stocks that I'd like to buy eventually going on sale too, maybe sooner than later. And to me, that's why I like keeping tabs on some of these macroeconomic factors. But I know on the whole, a lot of the best investors like Warren Buffett and Charlie Munger basically pay no heed to some of these macroeconomic things going on, like what the Fed might be up to or how much interest rate yields will be. So all of this is not such a big deal in the grand scheme of things. And if you enjoyed this video or learned something, please like and subscribe, and let me know in the comments what you think about some of these indicators. Do you keep tabs on them, and do you think there's value in keeping tabs on them? Let me know. I'd love to hear from you. Till next time.